to Ohio, but my city was gone. There was no.
All right, guys, it's 11:30. Let's get started. Jeff, if you can hit the record button, that'd be great.
Got it. Recording. Hey, everybody.
All right. Hey, everyone. We're going to get started here right on time. And I want to thank you for showing up here today. Super, super important content. I cannot tell you in the 25 years that I've been in practice, every year Prop 13 becomes more and more important for many of our clients. And I'm very glad that you're here today because we're going to kind of pull the curtain back, kind of pop the hood, so to speak, on what the heck is going on with Prop 13. And many, many people lose it, even if you don't die. Okay. There are a lot of ways that you can get reassessed on property. And there are a lot of ways that you can find out that you've been reassessed when frankly, it's just too late. So you're going to have to control the slides, Jeff. I don't have that control. Before we get started, this is for information only. I will tell you that Prop 13 is one of the most complex areas of taxation. Income tax, capital gains tax, estate tax. It's right up there with the big boys. You do not want to take information here and just run off and do stuff and, sign deeds and do all sorts of things. I can tell you before we, as a law firm, many instances, before we will advise a client, we actually check in with the local county and frankly, before the Board of Equalization and make sure that what we're doing isn't going to mess stuff up because we even need guidance from the taxing authorities. So very, very complex area. But again, this is information only. This is absolutely not legal advice. This is our team. That's me on the left-hand corner. Jeff is on the far right. You can see we've got 7 lawyers. Each of these lawyers practices in the area of trust and estates. Prop 13 is the purview of trust and estates lawyers, typically, sometimes business transactional lawyers. We have offices throughout the state of California, in the LA area, and Orange County, and in the Capital Region, in the Sacramento region. And anyway, so we got a lot of people. Many of these people are going to live pretty close to you, frankly, because we have offices kind of all over the place. All right. So why are you guys here today? We got a lot of people here who have tuned in. They're like, you know what, Prop 13, I don't want to lose it. I want to find out what's going on. What we're talking about is avoiding reassessment. Typically when you pass away, but sometimes not when you pass away, but maybe someone else has passed away. That would be another context. And how can you and your family avoid reassessment? Okay, so what reassessment means for most people is that your tax bill goes up. Now, I don't know about you, but 99.9% of our clients do not want their tax bills going up. We have some clients who they don't care, but that's okay. That's probably not you because you're here. We're going to go over what the current laws, and this is very, very important, what the current laws in California are. You may have seen in the news that there is a ballot initiative that was approved by California's Attorney General Javier Becerra that will be on the November ballot. What they are seeking to do is they are seeking to roll back Prop 13 for industrial and commercial properties for entities that have more than 50 employees. Now, you may think, well, that doesn't apply to me, because I don't have a corporation that owns a piece of property, or I don't have a partnership that owns a piece of property, or I don't have 50 employees. But I can tell you folks, I happen to live about 20 blocks from the state capitol in a place called East Sacramento. And all my neighbors are lawyers and lobbyists and doctors. And I can tell you, both Republican and Democrat, they're trying to figure out a way for California to get out of a more than $50 billion hole that we're in right now with COVID. And one of the things they're looking at, and they're looking at it really hard, is doing a partial repeal of Prop 13. So we're going to talk a little bit about that as we go through. But I think it's kind of like, as they say, the camel's tent in the nose, or the camel's nose in the tent, rather. Once they start unwinding Prop 13 a little bit, I think we can anticipate further rollbacks of Prop 13. So if you own real estate in California, very important to pay attention to this. And you really have to look at your estate plan. So if you're concerned about when you die, will my property be reassessed? You really have to look at your estate plan. And these aren't necessarily complex in and of themselves. Provisions in an estate plan, but these are provisions that can cause reassessment if they're an estate plan, or permit you to get what we call a reassessment exclusion. So where you're not reassessed when there is a change in ownership. So let's go to the next slide.
Yeah, and Jim, I think it's also worth noting that when we were preparing for the presentation, there's really so much you can talk about when it comes to Prop 13 and property taxes. You know, we could do like a 2-day course on this if we could, but we're going to condense all of this into kind of what we think is the most important things that we can convey in about 45 minutes.
Yeah, we're hitting the highlights. By the way, there is an assessor's manual. The portion that deals with changes in ownership in Prop 13, that's about 160 pages long. And believe me, it's dense, it's thick. And we look at that, Jeff, I don't know about you, but I look at that multiple times a week for clients because there's a lot of stuff in there that we just keep having to go back to the primary source material that's coming from the state of California. So Prop 13 passed in 1978. It rolled back taxes to 1975 levels. And it is the governing law. It was an amendment to the Constitution. It's amended Article 13A of the California State Constitution. And what it says is the maximum amount of property tax is 1% of something they call full cash value. Now, there's a provision in there or a line in there that says plus local add-ons. LA County, it's about 1.25%. El Dorado County is about 1.1%. So it depends on what county you're located in. There can be add-ons that counties put on. But for our purposes here today, what we're talking about is 1% of the full cash value. Now, full cash value, you can think of as assessed value for most cases. Sometimes the full cash value is less than the assessed value. If you're a disabled vet, for example, there's some other exemptions in there. But again, Jeff, as you said, this is kind of a broad sweeping, this is the 30,000 foot level of Prop 13. Now, you need to understand that your assessed value, your full cash value, is not the same as cost basis. If I pay $100,000 for a piece of vacant land and it goes up to $300,000, my cost basis is $100,000. So if I sell it for $300,000, I have to pay capital gains tax on that gain, right? Unless I visit with a lawyer here and we figure out a way not to do that. But cash value is not the same as cost basis, and it certainly is not the same as fair market value either. So here's what happens. If you buy a piece of property in 1990 for $100,000, your property taxes are $1,000 a year. Under Prop 13, those taxes can only go up in accordance with the California Consumer Price Index. Now, you may have never heard of the California Consumer Price Index, but what it is a measurement of the cost of goods, frankly. And that is capped at 2% a year. So that means if the California Consumer Price Index goes up 4%, your taxes are going to go up 2%. If the Consumer Price Index goes up 1%, your taxes go up 1%. If the California Consumer Price Index goes down 2%, which when did that happen? In the 2000s, right? 2008 through 2016, we had a slight deflationary, a few years where we had deflation. Then your tax bill does not go up and you can get tax relief. And for those of you who did that, you know that they slightly complex set of rules, but your taxes could go down, but then they went up more than 2% because there was a little bit of a catch-up provision there. But understand that California, how California taxes property has to do with essentially the purchase price plus the consumer price index. It really has nothing to do with the fair market value of the property. Now, I will tell you, we have many clients who bought a commercial property maybe for $1 million back in 1978, and it was rolled back to 1975 values. Well, maybe that went down to 500,000. And now going forward, their assessed value, because that 2% a year, they might have an assessed value of $1 million, but the property's worth $20 million. So you may have bought a property a long time ago, and when you look at what your tax bill is based on that full cash value, right? That's the assessed value for our purposes here. Your assessed value might be $1 million, but the property might be worth $20 million. So think about this. $1 million is going to pay $10,000 a year in tax. A $20 million property is going to pay $200,000 a year in tax. That's $190,000 less you're paying in taxes. And this is an extreme example, but many of our clients are in this situation. So, and for many clients, the viability of the business that they have that's attached to the property, you have a self-storage unit, right? You may not be able to make the numbers work if you got reassessed. if you had to pay the higher tax value. So Prop 13 is very, very important. We have almost 100 people on this webinar today. We have 100 people who are really, really concerned about this. So this is fantastic news. Okay, reassessment. So the property's assessed when you buy it. What does reassessment mean? Whenever there is a change in ownership. Change in ownership. Notice I did not say sale. I did not say gift. I didn't say foreclosure or whatever it is. Change in ownership, okay? So change in ownership, owner to former owner to new owner, okay? That is the classic situation where a property gets reassessed. So Jeff, if I bought a house in 1990 and my property taxes are $3,000 a year and the property is valued at $1 million, when you buy that property, you're going to be paying $10,000 a year because there was a change in ownership. I sold the property to Jeff. That is the classic change in owner. Well, change in ownership. What does reassessed mean? Well, it means that the assessor looks at the property and they put a value on it. Typically, it's going to be the sales price if it's an arm's length transaction, right? So if it's not an inside transaction, if it's a you sell to a third party purchaser, many times the value, the assessed value, will be aligned with the purchase price. Not always, but typically it's aligned with the purchase price. Boom, you get a new base year valuation. And then the new owner, Jeff, in this case, the maximum that his taxes could go up would be 2% a year, even if the property goes up 10% a year, okay? So a change in owner, well, go back to one slide. Now, there's some other weird things that they consider changes in ownership. If you say, I'm gonna lease my property to this person for 35 years, that's considered a change in ownership. Now, how many people sign a 35-year lease? Not many, but we see it. Creation of a joint tenancy or a tenancy in common. If I have a property and I say, you know what, Jeff, you've been such a great employee, I'm going to put you on title to the property. So I transfer that property to Jim and Jeff as joint tenants. I'm going to get reassessed on half that property. So a lot of people say, I'm going to add my kids to my property. I'm not going to tell you why that is generally a bad idea for a lot of reasons, but one reason is a potential reassessment, okay? Very, very important. Most frequently, it's when somebody dies or there's a sale. So when I say change in ownership, we put a question mark here. What does this mean? It can be between spouses. That's actually not considered a change in ownership. And for this purpose, spouse and registered domestic partner, those are interchangeable under California law. So if you are a registered domestic partner, which is going to be, oftentimes we see this people over 62. So this is a weird rule, but if you have a heterosexual couple over the age of 62, they can do a registered domestic partnership. Same-sex couples can do registered domestic partnership under the age of 62 or over the age of 62. I don't know why people who are, anyway, that's a whole other kettle of fish, but understand registered domestic partner is the same as spouse, okay? There's a parent to child transfer. We need to pay attention to who is the grantor and who is the grantee. The grantor is the person granting the property or giving or selling the property. The grantee is the person who buys or receives the property. We need to pay attention to the relationships because it's highly relevant to Prop 13. There's a grandparent to grandchild transfer, transfers to trusts, and entities. These are LLCs and partnerships. What we didn't put up there is corporations. Now, some of you might have a property in a corporation. That was a very common transaction in the 1960s and before. So we have a lot of farmers with property that was transferred to a corporation. But what we'll be focusing on are LLCs and partnerships. Corporations are a little bit more difficult to deal with. So parent to child exclusion. You've got this beautiful home here. And this applies to transfers after March of 1996 and both directions, meaning parent to child or child to parent. A principal residence of any value. Now, let me back up on this. When Prop 13 was passed, this didn't exist. So Prop 13 was all about, I think it was Alan Cranston who said, hey, if you own the property long enough, you're going to live in $1 million neighborhood, right? Because property was going rapidly in the 1970s. And what happened is people were, their property tax bill went up faster than their fixed incomes could afford to pay it. And so the voters said, this is ridiculous. And they passed a constitutional amendment. Now, something you need to understand is this is a new thing. And you can thank Dianne Feinstein for this because she owns a home in Pacific Heights in San Francisco. These are multi-million-dollar mansions between $10 and $70 million. And so she got this through. And you can leave a principal residence of any value. So you could have this, let's say this beautiful mansion here might be a $20 or $30 million residence, and you might have an assessed value of $5 million. Well, guess what? You leave that to your child. There is a parent-to-child exclusion. Now, you have to claim it or you lose it. We'll talk about that a little bit later, but the principal residence of any value. And Diane Feinstein, I believe her house is on Lion Street. If you guys are familiar with the Lion Steps, it's a great, if you're ever in San Francisco, it's a great place to run up and down. She has this beautiful mansion with beautiful views of the Golden Gate. And she's going to be able to pass that to her kids, and the property's not going to get reassessed. So good deal. Now, $1 million of other property. This is full cash value, not fair market value. So what this means is, if I own a commercial property that's worth $20 million, that example I gave before, I own a commercial property that's worth $20 million that is assessed at $1 million, I can leave that to my kids and they don't get reassessed. That's going to save the kids $190,000 a year in taxes. I think you can see why the legislature is looking at Prop 13 and they're going, you know what? You got Chevron and you got Apple and you have Google and you have Facebook and you have all these big companies that have these properties. They will never get reassessed. It's just going to go up with the maximum 2% a year. So the state is having, as always, a difficult time raising money. That's why they're looking at it as a big, fat, juicy target. And that's why it's on the ballot in November of 2020. So this is based on the full cash value, which is essentially for our purposes here, the assessed value. And this is fantastic. So the $1 million is cumulative over the lifetime. So if you make a gift of a $400,000 a property that has a cash value of $400,000, then only $600,000 is left over. And this is statewide. It's not county specific. You can use that $1 million anywhere. If you're married, you can double up on that $1 million exemption, but I will caution you, your trust has to be written correctly. There are many trusts that say, I'm just going to leave everything to the spouse. If you have one of those trusts, you're not getting $2 million in exemptions, because if everything goes to one spouse, now you have one spouse who owns everything. You can't save that extra $1 million just by wanting to save it. You actually have to have a structure in your trust. So if you have a larger portfolio of property and you're married and you have a trust, that's something where you're going to want to talk to Jeff or you're going to want to talk to me, and we're going to be able to look at your estate plan and make sure it's written in a way so that it preserves your parent-to-child exclusion. Now, this is kind of interesting. It is a race. You got kids here, right? You got 6 kids. They're racing. Whoever files their claim first wins. Whoever files their claim first wins. So if you have 5 kids and one kid's really smart and they inherit property and they race to the courthouse, so to speak, they can claim that. So this is a claim controlled by the beneficiaries. So if you don't pay attention to this, you're going to lose it. And there is a time limit on this. The outside time limit is 3 years. And if you don't claim it within 6 months, you have to pay a filing fee. Now, the transfer date is the determining factor, meaning the people who get it first, it's the determining factor. And if they're done at the same time, the beneficiaries must decide. And by the way, if you're the executor or successor trustee of a trust, you have a duty to treat the beneficiaries fairly. This is a discussion that you should have. It's a discussion that your lawyer should have with you. It's a discussion that we have on what we call the trust administration side. So when people set up a living trust, that's called estate planning. And trust administration is after somebody dies, we help clients through this. And I can tell you, so many people that say, I think this happens automatically. I talked to my CPA. They said, I just distribute the property to people. There's no problem. Well, a lot of people don't know about Prop 13. And if Prop 13 is important to you, then you need to make sure that your successor trustee, your executor, your family is aware of this, because if they just sit on their hands, they'll lose it. Property will be reassessed unless you make a claim for the exclusion. Okay, you have to claim it.
So Jim, speak a little bit as to who typically makes that claim. Is it the successor trustee of the estate? Is it the child themselves who files that claim? Who does it?
Well, first of all, my mother-in-law passed away a couple of months ago, and we just had the memorial service on Saturday. And Sunday, we kind of looked at each other, and of course, Father's Day was Sunday. and we were just totally exhausted. It's emotionally exhausting. So I think first we have to look at the context. For many people, I mean, some people are happy if their parents die, I guess. I don't know. But, you know, we certainly weren't. My mother-in-law was a wonderful woman. And it is emotionally taxing. This is very esoteric, highly complicated, very confusing. It's the lawyer typically that drives this, not the CPA, even though it's taxes, not the CPA, not the financial advisor. Most financial advisors don't know anything about this. It's going to be the lawyer. It's going to be the trust administration lawyer and somebody who's skilled in identifying the issues. And I will tell you, it's it's a lot easier to identify if something is done right than if something is done wrong. And it takes an expert to look at something and say, well, I see what's written, but something's missing. And we have a question in the Q&A here. Does this $1 million exclusion apply only in case of residences, or can it be applied to commercial property owned by the deceased? Under current law, as of June 2020, it applies to commercial property. It applies to all real property. So we answered that one. All right. Parent-child exclusion. What qualifies as a child? Well, a child. Now, California defines a child if there's a parent-child relationship. If there's a parent-child relationship. Sometimes it involves foster children. Sometimes it's stepchildren. Sometimes it's people, you know, it's different if you're under the age of 18 or over the age of 18. But this is all something that your lawyer can go through with you. What about a stepchild or the spouse of a stepchild while the relationship of a step-parent and stepchild exists only? That qualifies, right, Jeff? You wrote the slide deck, yeah?
Yeah, it's a very confusing one. You have to think about it very carefully, but yes, that does qualify.
Son-in-law, daughter-in-law exists. That's fine. Even if one spouse dies, but if you remarry, that's a problem. So, and these are all things. Again, the stepchild one. That's one thing that if I were working on a matter, I would go back to the assessor's handbook and look up the rules. So there are a lot of esoteric rules. And something you need to understand is that if it's an adopted child, they must be adopted while they're a minor. Very important. I suppose unless consent was withheld. So that might be a different situation. But again, these are all very complex situations, and we need to look at it case by case. We don't see a whole lot of stepchild. We see a lot of son-in-law and daughter-in-law.
Yeah, and interestingly, and I think you touched on this a little bit, but interestingly, for Prop 13 purposes, what qualifies as a child is a little bit different than what we call intestate succession purposes. So intestate succession, very different concept than this, but that's basically California's default law on who receives your property if you pass away without a plan. And people who may qualify as children who are entitled to inherit your estate if there's no plan in place may be different than the definition of who a child is that qualifies for Prop 13.
Yeah, for example, a son-in-law is not an intestate heir, but you might have a son-in-law make a claim, and if that's done before a child, you know, a brother or sister-in-law, that son-in-law or daughter-in-law may actually claim that exemption and take it away from another kid. So you gotta, you know, it's best that you don't, it's best that people just don't do this independently, but you have to have a cohesive plan. So parent-child exclusion, what is a principal residence, right? What is that? That's a place you're living in. It's a place you claim as your principal residence. And the number one way you identify that is with the homeowner's exemption, the $7,000 exemption. That's typically what shows who where your principal residence is. And it's also intent to return. And this only includes the portion of land reasonable in size used for the residence. Now, in the Sacramento region, some people will live on a house and they might have 500 acres surrounding the house. Well, guess what? You don't need 500 acres to live on. You're growing rice, but they're going to carve out what doesn't get reassessed. So again, this is a case-by-case basis. One unit in an apartment complex. I live in a neighborhood that is a mix of single family, and we have 2 fourplexes across the street from us. It's kind of more of an urban area. So if you occupy one of those units and you've got 3 other units, and this is also very common in the metro LA area, you're going to get reassessed potentially on the remaining 3 units, but not the one unit. And
Jim, that surprises a lot of the clients that I work with who are in that situation. They say, well, gosh, you know, I own this whole apartment complex, right? Isn't this going to be a parent to child transfer when I transfer it to my kids. And unfortunately, if you're just living in one unit because that's your residence, only that one unit will qualify for this.
True. And so then you're starting. So if you say, gee, only that one unit of 4 is going to be my primary residence and the other 3 get reassessed, you then have to ask yourself, well, do I still have that $1 million exclusion amount? And if you do, you're okay. But if you have multiple properties, you might not be okay.
Yeah. And interestingly, when you pass on a property to a child, the child doesn't actually have to use that residence as their personal residence. What really matters is that it was basically the parent using it as their personal residence. And if it were flipped, it would matter if it was the child's personal residence, because this one goes both ways.
Yeah, so it's the person who's making the transfer, who owns the property. It's got to be their personal residence, not necessarily the recipient's. And we do see that, Jeff, we do see that a lot. We have a lot of clients in West LA. You know, they bought a house in Westwood years and years ago. The assessed value is $500,000 and the market value is $3 million. And what are those renting for now? I don't know, 10 grand a month, 5 grand a month, 8 grand. So they may want to keep that income coming in because that's a pretty solid income. And, you know, you're only paying $5,000 a year in property taxes instead of paying, you know, $30,000 a year. So that's good. Now, grandparent to grandchild exemption. This is one that was added on. So it's, you know, they keep adding layers and they keep adding benefits on this. This only goes one way, only grandparent to grandchildren. And everyone has to be, I mean, I hate to use the D word, everyone has to be dead. So both parents have to be dead. So if it's a grandparent leaving it to a grandchild, then both of the child's parents must be deceased. And it generally does not apply to the principal residence. So this is a biggie, only to the $1 million in other property. And the principal residence is excluded only when the grandchild did not receive a residence from the deceased parents. So, wow. That's a lot. I mean, if you're looking at this going, I don't know what these guys are talking about, but your principal residence is excluded, meaning you get that principal residence transfer if the grandkid didn't inherit a residence from the parents. So this is how weird and granular this is. Really, really deep stuff. So you want to take the case study, Jeff?
Yeah, so to highlight this, imagine this scenario. So we have parents, and parents die, and they leave their residence to their child. And the child is also a grandchild, right? But it's the child of the parents. And so eventually grandchild inherits the residence, but he doesn't claim the parent-child exclusion. So he inherits it, but he doesn't claim the exclusion. Later, the grandparents die, and they leave their residence to the grandchild. So now the grandchild has inherited 2 residences. In this instance, the grandchild may not claim exclusion on the grandparent's residence, even though he didn't claim the exclusion on the parent's property. So the grandchild here can't make the argument that this is a transfer of a primary residence excluded from reassessment, but they can, if there's available amounts, they can still make that claim based on the $1 million of other property that the grandparents can leave. So yeah, it's a mouthful for sure.
You got to claim it, folks. And there are a couple of forms you file when you file a deed. The preliminary change in ownership report is not the form that you file. That's a form that goes with the deed in order to avoid an extra $20 fee on top of whatever recording fees you have to pay. And the preliminary change in ownership report, the purpose of that is to give some background on to the assessor and the recorder on what the heck is going on in the transaction, what the relationships are in the parties, whether there should be a documentary transfer tax, a whole bunch of other things. That is related primarily to the actual change in ownership. The claim for reassessment exclusion between parent and child is the form that's filed to claim your exclusion. And there's a different one between grandparent and grandchild. And Agnes has a question. Does it have a minimum period of time you must live in the residence in order to claim as a principal residence, assuming you have more than one house? Jeff?
Yeah, that's a really good question. I actually don't know specifically, but I would recommend someone who's considering this to probably make that place your residence for, I would say, at least a year, maybe a year and a half before making the transfer, just so you have a solid argument that that is your personal residence. So residency, the way we determine residency in California is actually a very sophisticated analysis. But you want to make sure that that's the place where you intend to return. So even if you're not living in that residence, if you can say that you intend to return there, you may be able to claim it as your residence. So for example, I have a client who has a residence in Ventura County, but she's temporarily living in Arizona taking care of her brother, but her residence isn't necessarily Arizona. She intends, as soon as she's finished taking care of her brother, to move back to her residence in Ventura County.
Yeah, and this is one of the, I will say from the client perspective or the consumer perspective, one of the frustrating aspects of Anglo-American law. Our legal system comes from England. And then when Napoleon conquered Europe, he imposed the Napoleonic Code. The Napoleonic Code, for example, the difference is the Napoleonic Code would say, you have to file this form to claim it as your residence within this period of time. I mean, that's an example of the difference in the legal system. So there's all these, well, it depends in our legal system, and in other legal systems, you don't have that same sort of vagueness, quite frankly. And Lisa asks, do the attendees receive a copy of the presentation? Yeah, we'll send a link. We're recording it and we can make that available. We'll send up a follow-up email. And Jim is asking, when leaving properties to more than one child, oh boy, I love this question. When leaving properties to more than one child, can the trust direct which property or child can claim the $1 million exclusion and therefore avoid a race to file situation? We're going to pick that up in a little bit. The short answer is yes. And again, that's something, you know, I will tell you, this is one reason to hire an expert lawyer. Whether you hire our firm, whether you're a client of our firm, or you're thinking about hiring us as your attorneys, you absolutely please hire an expert who knows this area of the law, because if you just do a normal trust without consulting with an expert, this is a very, very important, very valuable part of your estate. So a lot of people don't think that Prop 13 has a value to it, right? A quantifiable value, but it does, because one person is going to pay less taxes going forward and the other one's going to pay more. And there's value to that. We can ascribe a future value and discount it to current dollars. And one of the things is, I think the Prop 13 reassessment is inconsistent with trust law and trustee law in this regard. The trustee of the trust, who's handling all of this, and the trustee of the trust, by the way, can take certain actions that might cause reassessment or prevent reassessment. The trustee has to deal fairly with each beneficiary. They can't favor one beneficiary over another. So to your point, it is very important, if you want to favor one child over another, that's a conversation you need to have with your estate planning attorney, and that should be in writing and it should be in your estate planning documents. So claiming the exclusion, that goes through the county assessor's office. Each county assesses the job of the county assessor, by the way, is to go, that property's worth $100,000. Now you can dispute that, but the assessor's job is to say what property is worth. It's the tax collector's job to collect the tax, okay? To send the bill, collect the tax. And if you get in a fight over the value of your property, you don't go to the tax collector's office, you go to the county assessor's office. These are generally due within 3 years of transfer, meaning somebody dies, you got 3 years to claim it. And here's an interesting one. What if the property is not distributed from a trust for 20 years? So here's what we hear a lot. We get this call. Yeah, Mr. Cunningham, my dad died 10 years ago, and I didn't do anything. I just been living in the house. My brothers and sisters said, you know, you took care of dad for so long. You can get your life back together. Go ahead and live in the house. And they say, you know, I haven't done anything. All dad had was a house in Pacific Palisades that he paid $300,000 for. You know, it's worth $5 million. And they say, well, I want to administer the trust. This is really sad. There's going to be a fight with the assessor's office and the tax collector's office, because they're going to go back 10 years and they'll say, hey, 10 years ago, that $5 million property is worth $3 million. And you should have been paying another $25,000 a year in taxes. You owe us $250,000 in taxes. And that's a fight that happens. We don't see it frequently, but we see it maybe once a month, where someone will call in and it'll be, you know, maybe not that extreme, but those taxes are due and they will have to be paid. And in that situation, Jeff, 10 years, I think they're out of luck, aren't they? Because I see some flexibility in 3 years.
Yeah, so there is the ability to file a claim for exclusion after that 3-year window is closed, but the rules are quite complex when it comes to it. Sometimes you have the opportunity to do it, sometimes you're out of luck. So getting on this, if you're a child or a grandchild who's going to be claiming this exclusion, this is the kind of thing that you don't want to wait to get this on your radar.
Yeah, and we'll hear from clients. The husband will die, the wife will come in, sort of the archetypal little old lady, and she'll say, "Well, my friend said not to do anything for a year. They said, Gladys, don't do anything for a year." That's not really a good idea, because the way these trusts are written, sometimes they fund different trusts, and you may need to deal with property tax situations. So it's very important. It's one thing to not get married for a year. It's one thing to not move for a year, but you really need to talk to your lawyer when somebody passes away. Mary asks, is it better to sell a second house and pay 20% capital gains tax now, or a person inheriting pay taxes after the $1 million exclusion? Mary, I'm glad you asked that question. I think you're putting together two kinds of taxes. And again, for most people, I mean, unless you're really, really, really wealthy, okay, unless you're more than $20 or $30 million in a value of an estate, it's better to hold on to that house and wait till you die, because if a property is included in your estate, if it's not in a B trust, and we won't get into what that means, but typically when you die, your property gets an adjusted cost basis. So what that means is if you paid $100,000 for a property and it's gone up to $300,000, if you sell that property, you have to pay tax on your gain of $200,000. If you die owning that property, your kids can sell that property and not pay any tax. All right. So that's a good thing to hold on to it. But again, that's another thing where you're going to want to talk to the lawyer about your estate plan. Transfers to trust. So you transfer a transfer to your living trust. A transfer to your living trust is not a change in ownership. Okay. A transfer to your living trust is not a change in ownership because there is no change in beneficial interest. If you refinance, is there reassessment? No. Refinancing doesn't cause reassessment. And I was talking to a commercial real estate broker, very successful real estate broker on the commercial side. And he said, well, when you refinance, it's a change in ownership. And I didn't say anything, but it's not, just refinancing doesn't change your property taxes at all. And then we have a question. What is that 10-year deadline in the other slide about trust administration? So that Benjamin asks a question. And I know I'm talking a little fast because I get really excited, but we will have a recording. Here's what I'm talking about. Somebody dies and doesn't go visit with an expert lawyer in this area. They do nothing for 10 years. There are consequences to that. There are real consequences. And as we say in the law, everything sees the light of day. One day that property will trade. One day that property will change hands. Let's say it's not 10 years. Let's say it's 30 years. And finally that person dies. And then the property is sold. The assessor's office is going to connect the dots. They're going to see what happened. All right. And then there will be something called a supplemental unsecured tax bill. Now, a better tax bill is a secured tax bill. What a secured tax bill means is that recovery is limited to the value of the property. An unsecured tax bill. So if any of you have bought a piece of property in California, about 11 months after you buy the property, you get something called a supplemental unsecured tax bill because it took a while for the assessor to get around to reassess the property. Well, they're going to send you that tax bill from the date, the moment the property traded, the date that property sold. They may not get around to assessing the property for 11 months, but you're going to pay that extra tax for that 11 months, and they're going to send you an unsecured bill, which means you're personally obligated for it. It's a personal liability to you. It's not limited to the property. So transfers to trust are not a change in ownership. Now, this last point is if you're married and you have more than a residence and more than $1 million in assessed value in property, and you want to preserve Prop 13, something you should consider is that when one spouse dies, you have a mechanism that when that one spouse dies, the property goes into a special type of trust. It's actually a common trust for estate planning lawyers that preserves that extra $1 million exemption. So let me say that again. If you have property and your assessed value is greater than $1 million in addition to your residence, and you want to preserve that for Prop 13, and you are married, you need to check in with an expert lawyer, check in with Jeff, check in with me, and make sure that your trust is written so that you double up on that $1 million exemption, that $1 million exclusion, and you don't lose it. Okay? Very, very important. Many lawyers do not pay attention to that.
Yeah, that's a really cool strategy that is, not always appropriate for people, but when it is appropriate, it makes a lot of sense to do. And interestingly, when it comes to that, if the spouse who passed away already used up their $1 million exclusion by transferring property during their lifetime, then this strategy is not going to work. There's going to be nothing left over to preserve. So that's important to note there.
And you know what's interesting on this, and Jeff, I'm glad you raised that. A transfer does not mean a gift. For example, if parents want to give a property or sell a property to a child, right? Let's say they have a $500,000 rental that they paid $100,000 for, and your property taxes are $150,000. They can sell that rental to the kids. Now there might be some capital gains tax issues on that for the parents, but they can sell that property to the kid, and the kid can pay good money to the parents, right? Can pay the parents money, and the kids can still get that $150,000 assessment and not have that kick up to $500,000. So they can keep their property taxes at $1,500. Those property taxes don't go up to $5,000. That saves the kids $3,500 a year times how many ever years they hold the property. And that, guys, this is a real tax benefit, especially with the SALT limitations, the state and local tax limitations that we have now. You can only deduct on a personal residence and your personal California state income taxes, you're capped at $10,000. So very, very valuable. Prop 13 is a very valuable property right for Californians, and it's worth paying attention to. Richard asks, can I confirm that transferring a property to an LLC, single member, husband and wife, does not trigger a change in ownership? If so, can you sell the LLC to a party? Does that avoid a reassessment? We're going to get to that, I think, in the next slide. The answer is no.
Yeah, a couple slides from now, we'll talk about that.
Slides from now. But
I'm going to skip over this case study. I think we really drove that one home. So,
multiple, you want to cover this, multiple beneficiaries? I can.
Yeah, certainly.
Okay.
So you got to be real careful. So if you're going to set up a trust, and that trust after you pass away is going to provide for multiple beneficiaries, if within that group of multiple beneficiaries, there's somebody who doesn't qualify for the exclusion, you may blow the entire exclusion altogether, right? So here's how this kind of plays out. So mom and dad, they transfer their property to their trust, and they're both the owners of that trust. Eventually they die, their trust becomes irrevocable, and the trust provides that there are going to be 3 beneficiaries. So the son, the daughter, and their favorite nephew are all going to benefit from this trust. The trustee can distribute income to them, can distribute principal to them over the lifetime of those 3 people. Eventually, the trustee starts distributing to the son and the daughter, and they don't distribute anything to the nephew. But when they file that claim for exclusion, they're not going to get it because that nephew is not a child, right? It's a nephew.
It blows the whole thing. It blows the whole thing.
Blows the whole thing. So son and daughter can't say, hey, we have 2/3 of this trust. We should qualify for that much in exclusion. It blows the whole thing. So you really have to, you can still set up a trust, folks, where you provide for multiple people in your family, but you have to be very careful how you structure it so as to not blow this parent-to-child exclusion.
Yeah, and you know what? I'm just going to say something. I would say that this is kind of a sneaky problem. And what I mean by that is, lawyers for many, I started practicing law 25 years ago, and the focus was estate tax, death tax. The exemption was $600,000, and so we were focused on the death tax. 99.9% of Americans aren't going to pay a death tax. You can leave over $10 million tax-free, over $20 million tax-free. For the vast majority of people, they're not affected by the estate tax. And so a lot of lawyers say, great, now I can handle these other estate planning matters for higher net worth people, but they're not paying attention to Prop 13. And so Prop 13 has tax consequences. This is important, and please pay attention to this. Proposition 13 means that trusts have non-tax provisions that have tax consequences. So Prop 13 means that trusts have non-tax provisions that have tax consequences. And that example that Jeff gave is a perfect example. I'm going to leave this piece of property to my son, my daughter, and my nephew. There's no tax provision in that, right? But if they would have said, I leave a third of this property to my son and a third of this property to my daughter and a third of this property to my nephew, that might be a different outcome, right? So that is not necessarily something where you would say, oh, that's a tax provision, but an expert lawyer, right, sees the problem in naming all three as a beneficiary of a trust. All right, so I'm going to go back. This is great. So Richard, you asked the question, can I confirm that transferring a property to an LLC does not trigger change in ownership? That is true, as long as the grantors and the grantees hold the same beneficial interest. But when you sell the shares of the LLC, there's a reassessment, and that is the reason is you're selling more than 50% of the LLC shares. So many of our clients have been told by their business lawyer and their estate planning lawyer, do not hold a rental property or a commercial property or a ranch property or ag property in an LLC. This is a great example, a great idea. And here's the number one reason why you want to hold any kind of, frankly, any kind of property other than your residence in an LLC. You don't put your residence in an LLC because an LLC is a business. The number one reason is fire. Now, a lot of people don't think about fire, but if you start a fire on your commercial property that burns down 10 other structures, those other 10 structures insurance companies will be suing you for recovery. So if you cause the fire on your property, they're going to sue you. That's called insurance subrogation. What that's called, subrogation is the term. What that means is those other insurance companies are going to sue you, and it can really bankrupt people. There was a big fire in Southern California years ago that started on one of our clients' ranches, and it was a big problem for the client. So we kind of got schooled in this. That is very important if you have any kind of commercial or rental property or industrial or ag property. Look hard at setting up an LLC. Now, there's a downside to this. If more than 50% of the interests in an ownership, if more than 50% of the shares in an LLC transfer or change in control, So you may have a person who owns 1% and they control and they sell that controlling interest, the whole property gets reassessed. Okay? Very important. The parent to child exclusion does not apply when it comes to legal entities. So if mom and dad have that $20 million property with $1 million assessed value and they put it in an LLC and then die, and the kids inherit that $20 million property in an LLC, no parent to child reassessment exclusion, that property will get reassessed. Now, there is a strategy to get the property to the kids and not have it reassessed and still have LLCs involved. That's kind of outside of the scope of what we're doing here. But many of our clients do hire us to help them with that, quite frankly, is to make sure that the kids get the properties that when they come into our office, they say, hey, these properties are in an LLC. I saw your webinar. How do we get these to the kids and not get reassessed? We can help clients with that. So the step transaction, by the way, step transaction is a bad word, meaning where they ignore, the taxing authorities ignore all the steps you did and they mash them all together. Those steps have to be spread out. The headline on this is those steps have to be spread out over multiple tax years. And so this is a longer engagement. So in order to get a large portfolio of properties, 2 children, and avoid reassessment, it typically takes a 3-year time period or 3 tax year time period. So very, very, very important to understand. Do you want to talk about, am I talking too fast? I don't know. I feel like I'm just get so excited. I can't help it, but there's so much to cover.
Yeah, there's a lot of material here. So this is actually, I mean, all these slides are arguably important, but this is one of the most important, I think. This is one that comes up all the time when we're working with the trust administration.
Yeah, this is the most frequent one. Yeah, absolutely. The most frequent occurrence.
Yeah. So most trusts nowadays, and not all of them, but most of them will provide for something called a non-pro rata distribution. Essentially what that means is if you have a trust that's going to be divided up amongst several beneficiaries, they don't necessarily have to split every single asset in that trust down the middle. Perhaps one child gets a house and the other child gets a corresponding amount of other assets to balance that out. But a big problem exists if there's not enough liquidity in the trust to accomplish that. So let's say, for example, we have a trust there are 2 beneficiaries, 2 kids, and the primary asset is a house. And there's just a small bank account, right? And the kids are going to split that 50-50. That's what the trust calls for. Well, if one child says, hey, I want the house, and the other one says, well, hey, I'll take an amount of cash to balance it out. If the trust doesn't have enough cash within it, that creates a problem. Now, what a lot of people I meet with say, they say, well, hey, can't I just buy out my brother or my sister? I'll pay them for the excess that I'm receiving from the trust. And yeah, you can do that, but in the eyes of the county assessor's office, that no longer becomes a parent-to-child transfer. They actually see that as a sibling-to-sibling transfer. And for that proportion that doesn't qualify for that exclusion, you're going to have a reassessment. So what's the solution to this problem? How do you create trust liquidity to transfer the property without creating this failure to be able to claim an exclusion? Well, what some people do is they'll actually take out a loan. So there are lenders who specialize in doing this, where the trust will actually take out a loan to create liquidity so that cash can be distributed to balance out the distribution. So one child can get the property, the other one gets the cash. And what you can do is you can basically attach that loan to the property. So it doesn't blow Prop 58 or Prop 13, whatever you refer to it as, and you can still accomplish the objectives of the kids. Now, that is something that typically has to be done very carefully. It's something that is done through the trust administration process. So, when you're doing estate planning and you're evaluating whether you want to leave specific pieces of property to the kids, you're thinking about that, and the lawyer is going to guide you towards creating a plan that's not going to leave them in this situation. But sometimes you just can't avoid it based on the assets that exist in the trust. So this is one flexible solution to get around that problem. Now, one other thing that I'd like to bring up is imagine, a lot of my clients say, well, hey, I own several properties and I want to make sure that this property goes to this kid and this property goes to my other kid because they have a special bond with those properties. Well, if that person passes away and their trust contains those provisions, and the kids at that point decide, well, hey, I actually don't want this property. We actually want the properties that were going to the other one. If they decide to swap properties in the eyes of the county, that's not a parent-to-child transfer. That's a sibling-to-sibling transfer, and both of those properties get fully reassessed. So creating liquidity in the trust and carefully considering what properties you gift to specific people is something that should be top of mind. It comes up all the time.
Yeah, by the way, those loans, folks, those are oftentimes very expensive loans. They're not quite, I guess you could call them hard money loans. But the problem is you can't go to you hear like, hey, interest rates are down to 2.9% or something. You're not going to get one of those loans. Banks lend to people. Banks don't lend to trusts. So it's very important to understand that, and a lot of people, they kind of do a double take at the fees, the origination fees and the interest rate. But the point is you need to look at the value of preserving Prop 13 versus the cost of the money, the interim cost of the money. What a lot of people do is the trust will borrow money, then the trust will distribute the property with the associated mortgage, and then the beneficiary essentially immediately refis, does a cash out or just does a refinance at least to get the cheaper money. So very, very, very important. And a lot of people are really surprised on that, by the way. I will tell you, some of our counties are very big, like Los Angeles. Some of our counties are very small, like Sierra County. I think Sierra County has like 3,000 people. There's an entity called the State Board of Equalization. And the purpose of the State Board of Equalization is to eliminate favors in small counties, with bottom line, that these counties must follow the law. It used to be, so if you're watching this and say, well, when grandma passed away with the family limited partnership in the 90s, our property didn't get reassessed. Yeah, it didn't, because the state was not yet clamping down on the counties. And it's important to understand that the state is really paying close attention. Whenever they can reassess property, whenever the state can essentially force someone to reassess property, they will. They're vigilant.
Yeah. Now, Jim, this next slide contains 2 doctrines, I guess you could call it, that are rather confusing. Unpack these for us in the time we have left.
Yeah, original transfer doctrine means if my wife and I, well, this is a bad example, if Jeff and I acquire a piece of property as joint tenants, and I die, because Jeff is an original transferee, there's no reassessment. If you have a business partner, and if Jeff and I are business partners, we're both married, we both have children. If that property goes to Jeff, it doesn't go to my wife, right? It goes to Jeff. There is no reassessment. If I sell my half, my half's going to get reassessed. If we put that into an LLC and I die and Jeff continues on with the LLC, no reassessment. In fact, I can leave that half of my property that's in my LLC. In fact, I could sell half of my LLC shares because not more than 50% has transferred. So going back to that question, can a husband and wife put a property into an LLC and then sell the shares of the LLC? That will cause a full reassessment. But if you sell half the shares of the LLC, there's no reassessment. But once you pass 51%, the whole thing gets reassessed. Okay, very, very important to understand. And joint tenancy issues, I think I covered that. So if you're an original transferor and you're joint tenants, one issue that comes up frequently, more often than you would think, is siblings acquire property together. If they just transfer their joint tenancy half into their respective trusts, that's a problem. That causes reassessment. They have to go from joint tenancy to tenancy in common and then transfer the property to their trust. Okay, so a lot of people don't know this, and people end up getting reassessed. So, and there was a comment on here that Jim said, a lot of material, just getting gestalt. I have to review the recording for sure. That's the point of this webinar, because what we see with our clients is there's really just not a whole lot of awareness. Now, Anya, what a great time for this question. Both wife and I are 55 plus years old. Heard we can apply our property tax from our previous house, even if we buy a more expensive place in LA. Can you confirm this or discuss? Well, let's answer that. Perfect timing. I can't believe that. Here's the deal.
Yeah,
if one of you is 55 or over, you can move in the same county. If you buy a property of equal or greater value, you carry over your Prop 13. If you buy a house of less value, you get reassessed. If you have 2 years to do this, I believe after the first year, you can buy a home of 105%. No, it's less. Actually, I have it flipped. It's less. It's equal or less. You can't go higher. It's equal or less. So you can step down and keep your property. You can't step down and keep your property of a lower value. Then it goes to 105 and 110. So if you sell a property for 100,000 today, you can buy a property in 2 years for 110,000 and keep your low Prop 13 taxes. So that's a great question, Anya. Prop 60 is within the same county, so equal or lesser value. So if you have a property you paid 100,000 for, and now your assessed value is 200,000, and you sell for $1 million, you can sell that and buy a house for 800,000 in the same county and keep your $200,000 assessment. You can do that once in your life, one time. Now, Prop 90 says you can hop to other counties, and there are 10 counties, and you can see them here. Lots of Southern California counties, and you can move to those counties and you have the same deal. El Dorado County used to be on there, and then for some reason, the Board of Supervisors voted it out a couple of years ago, which I really had a problem with. But anyway, it's one time only, and it's your residence. And your replacement property has to be your principal residence. So you can't bundle this with a 1031 exchange. It's got to be your residence, and it's got to be within 2 years.
Yeah, well, that brings us to the end of our material, Jim. So what should people do?
Well, you're probably going like, wow, that was a lot of material in 58 minutes and 50 seconds. I totally get it. We will be sending you a link to a recording. But here's what I would recommend that you guys do. It's a great time to have your estate plan reviewed. And there are 2 steps. Number 1, make an appointment. And number 2, show up to your appointment. We're doing a lot of our appointments by Zoom. Like this platform. We can also do it by phone, but we prefer Zoom because we can actually see you. We also do have availability in our offices. Many of our clients just don't want to come in the office, and it's really almost like a Herculean sanitization effort to have people coming in and out of the office. We do have upcoming webinars, by the way. We do have a top 10 estate planning mistakes, which is a more general one. Another one that's a cool one is expecting trouble after you pass away. Special protection clauses for a trust. That's if you think there might be a fight after you pass away. And then we also have an asset protection webinar that's coming up. These are all on our website, by the way, and a young families estate planning. So estate planning for young families, people with minor children. So if you have any kids or grandkids that might need an estate plan, that's a good one to do. All right, Lisa asks, isn't there an upcoming proposition that will make the replacement property greater in value, okay to retain the property base? I'm not aware of that. That is in there, though, that if you go back a slide, you have 2 years, and if it's 12 months or 24 months, I believe it's 105 and 110%. But I'm not aware of that, but we'll certainly look into that. The one that I am aware of is the Javier Becerra approved for the November election, the doing away with of Prop 13 for commercial and industrial properties of entities if the entities have more than 50 employees. So if a good friend of mine is the CEO of a bottling facility for drinks in Northern California, and their entities own, and they have way more than 50 employees, and they own a lot of property, so that's the type of business where they would get reassessed. Agnes asks, do you mean to sell the property to your kid at a price a lot lower than current market price and the kid can benefit from the lower property tax? What I'm hearing there is if you sell a property to a child and you don't go through the claim for reassessment exclusion process, and let's say you sell $1 million piece of property for $100,000, if it were that easy, everyone would do it. The assessor is going to look at that transaction, and the preliminary change of ownership report will say that it's by gift, which is a flag that they need to pay attention. They're not just going to look at the sales price of the property, right? So if it's between people, if it's a bona fide purchaser for value to a third-party purchaser, a lot of times they look at the sales price. But if it's an inside transaction with the family member, or it's for obviously less than lower than the market value, the assessor is free to put any number he wants on there, and that's very important. You may pay $1 million for a house, and the assessor may come in and assess it at $1.2 million, right? There's an appeals process with the assessor, but the assessor's act of assessing the property when it trades, when it changes hands, is different than whatever value you ascribe to the property. What is the new prop on the ballot number called? Ironically enough, I think it's called Prop 13, which is horribly deceptive because people will vote yes on Prop 13 to keep it. So that was my point of saying and it's funny because you have these neighbors and then you find out what they do in the state, and these are very high up people. And I got to tell you, they're across the street from me, very high up in the state. They're scrambling. They're looking for ways to raise revenue because they have a massive pension obligation to meet, and the state is constrained. The reason the reason we have such high income tax in California is the state spends a lot of money on taxes. But one reason that we have such high state income tax is we have such low property tax. As a general statement, 2/3 of the state's revenue comes in through income tax. Jim says, glad I attended your webinar. I'll review the recording and get in touch with Jeff. Thanks. Fantastic, Jim. It was nice. Glad you could make it. We'll kind of do okay. So Mary says step basis and Prop 18, does it apply for siblings if no kids? No. If it goes to siblings, you're going to get reassessed. But there are ways that you can use a combination of LLCs and a combination of years to get property to your siblings. That's a pretty complex process. And for most people, they go, I don't want to deal with it. But it depends. So Mary, if that's something you want to look at, we certainly can talk to you about that.
Yeah, and Mary, just I think you're kind of asking two things, right? Does Prop 58 apply on the property tax, and then will they get a stepped-up basis for capital gains tax? And if your estate plan is set up properly or appropriately, it probably will. If you pass away and that person inherits it, if a sibling inherits it from you, it will probably get a stepped-up basis or an adjusted cost basis for capital gains tax purposes, but not for property tax purposes.
And Heather writes, thank you so much. Thanks, Heather, for writing this. Thanks. This was wonderful. I have an appointment set up with you and we'll bring my questions. That's great. I don't know any other law firm that's doing this. And the reason we're doing it is I've never seen anybody do this, but this is so important to know if you own property in California. And I'm so glad you guys, each of you attended today. You hung on past the hour. And I'm just, I'm really happy that we could be of help. So with that, we will wrap it up. If you have any further questions, you know how to reach us, 866-988-3956. And can you share this recording with your children? Absolutely. Jim, we'll send you the link and you can share that with your children. This is one that will, I think, go up on our YouTube page. But super, super important, folks. It's important that you pay attention. Also, super important is that you hire an expert lawyer. I wrote a book, Savvy Estate Planning, What You Need to Know Before You Meet with the Right Lawyer. It is available on Amazon and should be in the footer of the email you got. This is super important. We don't mention Prop 13 in this book, but you do need to hire an expert lawyer. So this is not, you know, estate planning is not for the generalist. You do need to hire someone who focuses in this area. With that, I think that's a wrap. Thanks for coming in today, guys.
Thanks, everyone. Bye-bye.